You own an investment property, but then you have a big ticket expense, that is capital expenditures. For example, changing the floors to vinyl plank, or painting the house, or could be changing the water tank, or could be basement development. Now, my question to you is, can you write off those costs to CRA? You own a rental property or investment property, but then you cannot identify what is net operating expenses or income or positive cash flow. Neither you are aware of capital expenditure or a budget. So I'm Jerry Moras here with the Experience in Calgary. Now I'm going to break it down. You know that owner's equity is assets minus liabilities. So assets could be what you own, could be property or the investment that you have, and liability is what you owe. So now owner's equity is what you own. When we talk about net operating income, whether it is income from the rental properties, could be laundry services or any services that we have within the property, then we have all the expenses that we have taken, operating expenses. It could be that we are paying out maintenance services, or it could be property management costs, or it could be property tax, or any expenses that you have, including the operating expenses. That is where exactly you have a net operating income. But then we will need to see the cash flow. It is important to have a positive cash flow to look at your expenses and incomes. So every month's expense, whether it's paying off the utilities or a property tax or insurance or management cost or any cost that is involved with the property, so you got to review, including the vacancy cost and the bad debts. So that is the expense side of it. When it comes to income, so are you getting income every month? Do you have any vacancies? Vacancy is a liability. Financial institutions, right? So if you are paying higher mortgage interest rates, you are not making money. It's important to budget 3 to 5% of expense as an vacancy or a bad debts. So when you budget the operating expenditure, we need to have a contingency budget. When we have an emergency situation, we have to make a big investment. For example, capital expenditures, or maybe a unknown expenditure of operating expense. So we need to have that in our budgeting expense. While the gross operating income covers only the vacancy rate and the debts, the net operating income covers all the income minus all the expenses. Strength is net operating income. Your strength is positive cash flow. So everyone is looking for a positive cash flow. In a residential property, when you collect rents, you don't pay GST. On a commercial property, we pay GST. You have an expense on this property. Could be property management, or could be maintenance and other miscellaneous expenses that you could write off this, right? For example, you own a residential investment property. It's a detached property of 500,000, made an investment of 100,000 with a conventional mortgage arrangement. Then you got a 400,000 as a loan. Then you pay monthly. But then you got other expenses like property taxes. Then you have the insurance, and so there is a condo fee. Utilities mostly paid by the tenant. So you get a rent of every month, something like 2,800. So there are two ways that you made gain on this property. One is owner's equity has been increased because every month you're paying off the mortgage. Secondly, your property is appreciated. So while you are getting rentals every month, you're paying off the cost as well. So you are taking care of the property, and property is getting appreciated, and you are owner's equity is increasing. So that is your money, your strength. So that is your positive cash flow. I do deal with the commercial property, especially when it comes to leasing. Not only the tenant needs to pay the rental cost, the basic cost, but there is also escalation clause as well as on rents. Then you have the operating cost. So what would be the operating cost on a, for example, let me put an example here, on a 2,800 square feet industrial warehouse. So you pay $19 per square foot as a rental cost, basic rental. Then you have got a $7 or $8 as operating cost. So what could that mean exactly? Basically common area maintenance or the property tax or insurance or any other expenses that landlord incurs on a property which has been added. Landlord makes an investment only for the building. The risk of owning a property in a commercial is really low. So when it comes to owning a property, especially in a residential, is high because all the operating expenses by the landlord. But then the other expenses, so for example, the renovations, and everything is done by the landlord in a residential, right? In a commercial, everything is taken care by the tenant. So planning to buy a residential or commercial, I'm here to guide you through. If your property is vacant and you're paying high interest on the property, you're not making money. And also you're not making money if you're not collecting enough rent. So it is a liability. Right now it is time to sell. Because we have got a lot of vacant properties in Calgary, we have a loss in revenue on the property. Considering Calgary's rental situation right now, it is important to monitor expected rental income. In order to achieve positive cash flow, we got to avoid the major capital expenditures. When you own a rental property, you are not here to give comfort to the tenants. So please avoid major renovations like kitchen renovations or a painting or any sort of improvement that needs a major cost. When you own an investment property, it is important to have a positive cash flow and you got to monitor the operating expenses. Thanks for watching. Jerry Moras here with the eXp Realty.